In this video, I'm going to present a solution to immediately drastically reduce the cost of originating a mortgage while substantially increasing pull-through and reducing fallout, and then discuss how to use this solution as a springboard to manufacture a 100% truly digital mortgage with full rep and warrant relief. This solution was informed by 29 years as a licensed lender broker, followed by over 11,000 hours of research and coding into developing a solution to manufacture a truly digital mortgage. Most of my videos are geared to helping MLOs, LOAs, and processors, and by extension, the branch managers, sales and ops managers, and C-level executives who employ them. While today I am still speaking to those groups, in addition, there is an opportunity for C-level executives at POS, LOS, and AI underwriting firms to see if they might be interested in partnering with me to integrate this solution into their offerings. The process of manufacturing a mortgage consists of capturing data, verifying data, and analyzing that data against a rule set. A truly digital mortgage would complete those steps at or near the point of origination with little or no human involvement. This is a far cry from the mortgage industry today, even though seemingly every vendor is screaming digital mortgage like a flock of parrots. At best, maybe 20% digital mortgage would more accurately describe their offerings. In a recent interview, Jim Deitch from Terra Verde said that it takes 60 hours of touch labor to close a mortgage, and 50% of the closed loans still require some sort of post-closing fix, and that in 2023 the average underwriter closed 115 units a month, while in 2023 that number was just above 20. What is causing such inefficiencies? The two foundational problems preventing the mortgage industry from moving towards a truly digital mortgage are that all the data necessary to underwrite a mortgage isn't systematically captured at the point of origination, and the rule set is not fully established at that time due to the hundreds of areas where underwriting guidelines are either missing, incomplete, or vague. Before we discuss a solution to those problems, let's step back for a minute and define what mortgage-backed securities buyers want. They seek a risk-adjusted rate of return on their capital. Nothing more, nothing less. Lenders seek to manufacture and sell those assets at a profit, while delivering a product that produces a risk-adjusted rate of return acceptable to their buyers. Nothing more, nothing less. It's the current lack of an efficient solution to these two fundamental, foundational problems that continue to drive the cost of manufacturing these assets to record levels. Are these problems solvable? Capturing all the required data at the point of origination can be completely handled in many cases and almost completely so in the rest of them. To explain, the start of the origination process is the completion of the IRLA, the pulling of a credit report, and then the submission of both into an AUS. While there is a multitude of data an underwriter will consider that is not captured in the IRLA, and no AUS underwrites for everything, with these foundational pieces in place, are we able to determine the balance of the data required for each individual file, including the background data to ensure that the correct values have been placed in the IRLA? I would argue the answer is yes, if a particular file receives an appraisal waiver and automated title clearance acceptance. And if appraisal and/or title work needs to be completed later in the origination process, those are the only data points that cannot be captured up front. Go ahead, outside of appraisal and title, assuming flood and/or property insurance can be obtained on satisfactory terms at a cost within allowable DTI limits, is there any data needed to make an underwriting decision that cannot be requested from the applicant at this time? If you can think of anything, please let me know. In a similar manner, is there any rule that cannot be established at this point in the process? Again, I would argue the answer is no. Now, could a file contain a data fact pattern that falls into one of the hundreds of underwriter discretion areas which compels the lender to get the blessing from the appropriate agency regarding their interpretation of whether or not a particular data fact pattern is acceptable to the agency? Yes, but as long as that data is captured at or near the point of origination and identified as requiring a discretionary decision, then this process can be completed at the front of the process. Actually, before the process formally begins when disclosures are issued to the applicant. Now we'll look at one example of an area where all of the pertinent data is not captured at the point of origination and the rule set for that data is not established by the agencies. For a conventional mortgage, someone else has been paying an applicant's car loan for at least 12 months. Fannie and Freddie are clear in that the payments must have been made on time and that whoever has been paying can't be an interested party to the transaction. But here's a list of the data that isn't captured on the IRLA and or is not specifically addressed in their rule sets. Number 1, has someone else been paying the bill for at least the prior 12 months? This data point is not captured on the IRLA. Number 2, has the same person been paying every month? What is the definition of someone else? This data isn't captured on the IRLA, and there is no established rule. If the uncle paid 11 months, but the aunt paid 1 month from a checking account without the uncle's name on it, does that meet the definition of someone else? Does it matter if the check the aunt used has the same address as the uncle's checks? What if the aunt and uncle are divorced or are married living separately, and the check has a different address than the uncle's? Is it acceptable if 2 sets of grandparents are paying alternate months? Number 3, was there a month with no payment made because the existing loan was refinanced or the car traded in for another? This data point may be captured from the credit report. And while there is some agency guidance about using best judgment and only omitting the lowest payment amount during the previous 12 months, there isn't a concrete guideline. Don't you love it when a lender asks an agency a specific guideline question and the agency tells the lender to use their best judgment? Number 4, has the niece-nephew been sending money to the uncle every month? Okay, I'll co-sign, but you send me the money every month and I'll make sure it gets paid on time so you don't harm my credit. This data isn't captured in the IRLA, and while most underwriters would not omit the debt if money has been transferred, there is no firm agency rule. Number 5, is the niece-nephew's name on the account the uncle has been paying from? This data isn't captured on the IRLA, and there is no rule. If their name is on the account, does it matter in what capacity? Does it matter how much money is in the account? Number 6, how about if the car note allows the skipping of 1 payment a year, so the account is reporting as current with at least 12 payments made, even though there was 1 month without one? This data point may be captured on the credit report, but there is no firm agency rule. Most underwriters will not accept this situation, but how is that different from a month with no payment made due to a refinancing or a trade-in? Let's say we have a file with scenario number 2 above. The MLO didn't confirm that the exact same person has been paying. When the applicant provides the payment history, that fact also slips past the LOA and the processor. The underwriter spots the discrepancy, and now they have found something they don't like. They decide not to omit the car payment. They rerun the AUS, and when the mortgage no longer receives an approval or an accept, they deny the file. What follows is a drama that repeats itself hundreds, maybe thousands of times a day across the USA mortgage world. The MLO turns to social media, often posting anonymously about their predicament, and seeks guidance. The answers will range from your SOL to "You are working for the wrong company, DM me if you'd like to work for a company that doesn't have such stupid underwriters." But the most common response is in a similar tone to a World War II submarine captain yelling "surface, surface, surface," except the words are "escalate, escalate, escalate." At this point, the battle ensues. First the underwriting manager, then the operations manager, possibly the national credit manager, and or whomever the MLO can get a hold of. Maybe the underwriter's decision is overturned, maybe not. If the MLO is brokering the loan, they can likely find an alternative wholesale lender, but will probably have a delayed closing. "Oh, you want us to hurry up for you, but you don't send us any business." Depending on how convoluted the payment history is, say the 2 sets of grandparents paying every other month, they may not get the loan closed. Now let's look at the financial effect on the loan officer and the company they work for. Only the most sociopathic MLO, okay, there are quite a few of those, won't feel a high degree of stress. Who wants to be the person to tell their applicant that they are not moving into their new home? Perhaps they've been living in their parents' basement, and they can just unpack and stay put. Or maybe they've been living in a motel in their new city for a few days while their possessions are en route with a moving company. Time to find an apartment and a storage unit for what won't fit. Let's say our MLO is a 3-loan-a-month producer. 1.2 million a month at 100 bips makes for a comfortable living. With 3 closings set, the MLO takes off the second weekend of the month to spend time with family. If the MLO realized up front that this loan wouldn't close, they would have worked that weekend at open houses to find that third loan. So that's 1 less loan for the month for both the MLO and their company. And with our MLO all stressed out trying to fight this loan and all the grief that comes with having to break the bad news to their customer and the real estate agents, it's very possible they end up off their game and lose the motivation to close 3 loans the following month. Let's be conservative and call it 1 more loan both the MLO and their firm miss out on. What about the long-term damage to the MLO from the realtor community? How much does that spread to the entire branch, even to the company as a whole? If you're C-level and you haven't modeled this financial impact, you are missing a substantial long-term expense. Are all of your company's underwriters on the same page, or is it an underwriter by underwriter decision? If it's the latter, is it any wonder why your company is continuously going through these types of battles? The key conclusion from our 11,000 hours of work is that identifying every discretionary area and the additional data points that an underwriter will request before making their decision was a solvable problem, and we have solved it for you. If you don't have a formal policy to deal with each of these discretionary areas, in addition to the operational problems, are you aware that you are at risk of fair lending violations as FHFA 2021-04 explicitly includes underwriter discretionary areas as being subject to fair lending? Has the same underwriter allowed another loan with the same fact pattern to close? If so, now you have opened yourself up to disparate treatment in addition to disparate impact. Have you ever seen a particularly charming MLO work their magic on an underwriter? The sale to the consumer can be challenging, but the real hard sale is to the underwriter. Compliance personnel. Have you pointed out this risk to your C-suite? Can your company survive the regulatory fines and private legal judgments if you are found guilty of disparate impact or disparate treatment? Time for the solution. Again, there are 3 processes involved with underwriting a mortgage. 1, data is captured. 2, that data is verified. 3, the same data is analyzed against the rule set. We've established that the 2 foundational problems are all the data is not captured at or near the point of origination and the rule set is not fully established at the time. That's why we've spent over 11,000 hours developing the complete 1003 software. By recreating the entire questioning sequence that a mortgage file goes through in underwriting, we are able to capture all the data not contained in the ERLA/1003, as well as the background data to ensure the ERLA is filled out correctly, and we populate it into a supplemental mortgage application. And by studying over 100,000 underwriting scenarios, we've identified the 212 areas where underwriter discretion come into play. The software lets a mortgage company know when an application contains 1 or more of these discretionary areas so they can be dealt with at or near the point of origination. The software is also customizable, so a mortgage company can establish a rule set for each discretionary area. We can assist you with this task, or you can build this rule set easily on your own. You can still allow for exceptions, but by establishing the area of what is clearly in bounds for each topic, you can avoid the expense of most of the back and forth fighting while protecting yourself against fair lending violations contained in FHFA 2021-4. If you are an MLO, LOA, or processor, or you employ these roles, you can use the software to complete a supplemental mortgage application for each file to make sure you have captured all the data that your underwriter will consider. And you can be aware of when your application includes a discretionary area so you can find out at the front of the process if how your underwriter will allow your scenario to get approved. And if your company elects to place their discretionary guidelines within your supplemental application, You'll know how your company will handle a particular situation regardless of which underwriter gets your file. If you are brokering some or all of your mortgages, your company can notify you within the software which lender they work with is more or less lenient, with specifics, on each discretionary topic. The net result is you'll be able to close every approvable file, and you won't have any files crashing and burning in underwriting, which comes with all the damages detailed earlier in this video. Companies can also use the software as a training tool to simulate hundreds of mortgage applications in a short period of time, so your newer MLOs will be on their way faster to being able to operate as error-free as possible without supervision. Most importantly, if you are an executive with a POS, LOS, or AI underwriting firm, or you are a lender and you'd like your POS, LOS, or AI underwriting vendor to add these capabilities to their solution, and would like to take a giant step forward towards providing your customers with a solution to manufacture a truly digital mortgage, we look forward to a discussion with you about integrating our solution within your product. We can provide you with a blueprint to engineer a truly digital mortgage, one where all of the required data is gathered, verified, and analyzed against the rule set at the point of origination. Please also reach out if you offer internal chatbots, so MLOs can instantaneously access underwriting guidelines 24/7, as we might be able to work with you to add in these discretionary areas. What will be the biggest impediment to manufacturing this 100% digital mortgage with full rep and warrant relief? The cause of all this fighting and expenses is the lender's biggest fear, which is manufacturing an asset that won't qualify to be sold into an MBS security and or an intermediate investor, or it will come back to them at a later date. And there are plenty of full-time employees at the investor level dedicated to finding the smallest flaw in the closed asset and demanding compensation to rectify the error, even if the asset is performing and producing the risk-adjusted rate of return. The portion of the solution I've described above is all achievable today. Now for a moment, I'd like you to imagine what the final step could be to producing a 100% truly digital mortgage, one that will require only a very limited amount of human involvement from a mortgage company and the investor agencies they sell to. What could happen if a mortgage company established a rule for every discretionary area, and an agency or another pool of capital agreed that they would accept without recourse any mortgage that produced a data set within those accepted rules? Then as OCR, AI, ML, and RPA capabilities advance, as long as the combination of source data and customer requested documentation provides 100% of the data needed, and that data conforms to the established rule set, the mortgage can effectively be cleared to close within minutes of origination, with little to no involvement from origination or operations FTEs. The agency or other pool of capital would have to agree that the proposed data set and rule sets are complete, that as long as the data set is captured and the rule set is met, the loan qualifies for full rep and warrant relief. How could establishing these fixed data sets and rule sets work in practice? We know that the AUS has only read the ULAD data points contained in the ERLA. There was extensive disruption in the industry when this application was expanded several years ago, so adding more ULAD data points isn't a workable solution. However, we can look at Fannie Mae's new self-employment income calculator as a rough guide how to capture, verify, and analyze all of the additional required data points. The way that Fannie Mae tool works is as long as the data from the tax returns is correctly entered into the tool, the resulting income calculation receives rep and warrant relief. Envision a tool that captures several hundred additional data points across the credit, income, assets, and property spectrum, and has a rule associated with each data point or set of data points. Then have one of the agencies or another pool of capital agree that as long as the data set is properly captured and conforms to all the rules, that those areas also receive rep and warrant relief. The final step is for a buyer of these assets to agree that the data and rule sets are complete, and that mortgage assets meeting this fixed data and rule sets are granted full rep and warrant relief. Buybacks and indemnifications can be limited to only extremely rare circumstances, such as identity theft if a lender makes a mortgage to an individual who isn't who they claim to be. Change management is always difficult, and there's an entire ecosystem built around determining whether or not a mortgage asset qualifies to get included in an MBS security. I call it the military-industrial underwriting QC complex. Excuse my cynicism, but is it really necessary to have all these FTEs involved? Underwriting managers, operations managers, VPs of credit, pre-closing and post-closing, QC personnel, folks at the agency standing by at the ready to bless or deny a specific fact set in writing, of course, unless someone else at the agency later decides they don't agree. And if you don't like the response, try the other agency. We understand that this ultimate goal is a big leap of faith forward, and the military-industrial underwriting QC complex will fight it every step of the way. But as long as these loans deliver an acceptable risk-adjusted rate of return, there is no reason why this vision can't become a reality. Ask yourself which scenario makes more sense for the modern data and computing power world we live in. The system we have now, where many loans devolve into hand-to-hand combat, necessitating so many FTEs that lenders can't originate loans at a profit, or a system along the lines I envision. How much longer can the present, inefficient, unnecessarily costly labor process continue in effect? Maybe we can't make 100% of the mortgage 100% of digital, but are you open to working with me to really move the needle forward on manufacturing a truly digital mortgage? If you'd like to see a demo of the complete 1003 software, either for use in its present form and or to discuss working together to develop a truly digital mortgage, you can reach me at alan@thecomplete1003.com, or you can set up a demo meeting. Here is my Calendly address. I'm going to let this tape run just for another minute so you can either capture my email or Calendly easily. I'm not going to go back and edit the video. I know I've stumbled 2 or 3 times when I've spoken, and I did notice a few surplus words in the text. But I think it's complete enough that you can understand what I'm trying to do, and you can figure out if you'd like to work with me or not.